Hi, my name's Tim Reed, founder of the Phoenix Group and PhoenixRealEstateInvesting.com. And today we're going to talk about why real estate. Why do you always hear that over 61% of the wealthiest people in Canada have most of their net worth in real estate? We're going to go over the 7 profit centers to explain why it makes so much sense as an investment in a great component of your portfolio. And there's 3 pillars to wealth: real estate and business investments and investments in the stock market. And this is why real estate is one of the best, because none of those other options, the other 2, have 7 different ways you can make money. So first of all, cash flow. So when you have a property that has expenses and you can rent that property for more than those expenses, you've got a profit every month that pays you passively every month, ka-ching, 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 and you get a paycheck from that. That's called cash flow. And often you'll hear that cash is king, but I really think that cash flow is king. Because if you have cash sitting in your bank account, that's great, but if it's not moving, if it's not in real estate or an investment, it's not cycling, then it's not growing. Money's just like we are. If we're not growing as people, we're dying too. And the next factor is PR, now public relations. It's called principal reduction. So if you have a mortgage on a property, your tenants get to pay that mortgage down, principal and interest every month, and that mortgage balance keeps going down and down and down. So you're getting your principal reduced by your tenants, another way you're making money. And then appreciation isn't something you can count on in real estate. That's speculation. That's kind of like rolling the dice and gambling. But statistically, over a long period of time, real estate's always going to go up. On average, it doubles in value about every 10 years or so in any market in Canada. About 3% on average across all markets. Some will be more, some will be a little bit less. But you can average it out over the long term at a pretty safe, reasonable estimate. It's going to be 3%. And then equity. As that mortgage gets paid down, you're building up equity in that property. You owe $100,000 on a property, for example, and it's worth $300,000. Now you've got $200,000 in equity that you can borrow against to buy more property and get a line of credit, maybe for renovations. You get a lot of flexibility once you start building up equity in your portfolio. One of the most powerful things in real estate. And then 5 is leverage. The great part about real estate is the banks know it's one of the safest things to lend on. If you go to your banker and say, "Hey bank, I want to borrow a loan to start a business for $50,000. They're going to say, "Okay, great, show me your plan. Give me a 150-page business plan and check your credit," and go. They're going to make you go through a ton of hoops to be able to lend you money on a business. But if you say, "Hey bank, I've got a piece of real estate I want to buy, and I'm going to put 20% down payment on that property," the bank will give you the rest of the money and charge you interest on it, because they know real estate's safe. And they know that real estate market rarely corrects 20%. So they've got equity in the property, they know they're safe, they know they've got good collateral. And real estate's one of the best, it's the best collateral you can have to borrow money from the banks. You can use leverage. And then you can reinvest that equity you can pull out of the property to buy more property. So that 20% you have to put down to get a mortgage from the bank, you can take that out of your equity from other properties as they start to get paid down. Or if you got an incredible deal on a property and you got it way below market value, then you can borrow that equity out of the property, maybe to renovate your next property you're looking to buy. And you get a lot of scale in real estate because you can use the real estate you have to leverage that into buying more real estate or renovating the real estate you have now, or an expense comes up, then you can use that leverage and get the capital you need to reinvest. And one of the best part of real estate is it's got a lot of tax advantages. And I'm not an accountant and I don't play one on TV, so please ask your accountant to figure out how all this will work. But it's not about how much money you make in business or in real estate, it's how much money you get to keep in your jeans. That's what's really important. And that's what business owners know, that business owners and investors leverage all the tax advantages they possibly can get, and real estate has a lot of flexible tricks and strategies you can use to lower your tax liability on the money that you earn through real estate. So that's the 7 profit centers in real estate. There isn't 7 profit centers in a business, and there isn't 7 profit centers in stock investing. It's one of the most powerful strategies there is to build wealth, and that's why we love real estate so much. My name's Tim Reed. Respect the hustle, everybody.